Your spouse dies on a Tuesday. By Wednesday, the IRS clock starts ticking, and it does not pause for grief, for funeral arrangements, or for the fog that makes it impossible to remember what day it is, let alone what forms to file. Margaret Caldwell, 73, from Overland Park, Kansas, buried her husband Dennis on April 3, 2024. 6 weeks later, the IRS assessed her a $14,800 penalty, not because she cheated, not because she hid income, but because she missed 3 filing deadlines she never knew existed. What makes Margaret's case so common and so preventable is that the IRS publishes these requirements in 7 different publications, spread across 4 separate sections of the tax code, and not one of them arrives in your mailbox when you need it most. There are exactly 7 things the IRS expects a surviving spouse to file within specific time frames after a death. Most widows and widowers know about 1 or 2 of them. Almost nobody files all 7 correctly. And number 4 on this list, the one Margaret missed, carries the steepest penalty and the shortest deadline of all. Dennis Caldwell had a modest estate, a paid-off house worth $310,000, 2 IRAs totaling $187,000, a small pension, joint checking and savings accounts, nothing exotic, nothing that should have triggered a $14,800 penalty. But here is what happened in the 42 days between Dennis's death and that IRS notice landing in Margaret's mailbox. The IRS received Dennis's death certificate from the Social Security Administration. That transfer happens automatically under IRC Section 6103 D.4, and most families don't realize it. The moment that death record hits the IRS system, your deceased spouse's tax identification number gets flagged. Every joint account linked to that number gets a secondary review marker, and a set of filing obligations activates with deadlines measured not in months, but in days. Margaret's accountant, the same one she'd used for 11 years, told her to wait until tax season. That advice cost her $14,800. What Margaret needed was someone to hand her a checklist on the day of the funeral and say, "Here are 7 things, here are their deadlines, here is the order you file them in." That is exactly what this video is. And the reason you need to stay for all 7, especially number 4, is that the penalty structure is not linear. Missing number 1 might cost you $500. Missing number 4 can cost you $8,000 to $15,000 depending on your spouse's IRA balances. I will show you the exact calculation the IRS uses, and I'll give you the form numbers, the phone numbers, and the exact words to write on each form so nothing gets flagged. But first, the one that catches everyone off guard within the first 9 days. Most people assume that when you report a death to the Social Security Administration, the IRS gets notified automatically, and that is sufficient. It is not. The SSA notifies the IRS of the death, yes. But that notification does not satisfy your obligation under Revenue Procedure 2023-34 to file a formal notification of taxpayer death. You need to send a written statement to the IRS Cincinnati office, specifically to the Account Management Unit, that includes the deceased's full legal name, Social Security number, date of death, and your relationship. Include a copy of the death certificate. Mail it to the address listed in IRS Publication 559, page 4. If you skip this step, any refund owed to the deceased gets frozen in the system for 12 to 16 months. Howard Pruitt, 69, from Murfreesboro, Tennessee, waited 8 months for a $3,400 refund that belonged to his late wife. The hold was released within 11 days once he sent the written notification. The deadline here is not rigid, but the longer you wait, the longer every other process stalls. Tax professionals I spoke with recommend sending this within 9 days of death. Some say sooner. The IRS itself does not publish a hard deadline for this specific notification, which is partly why so many people skip it. This form is the key that unlocks any federal tax refund your spouse was owed. Without it, the Treasury Department will not issue a check in your name, period. Even if you filed jointly, even if the refund was based on your combined income. Form 131-0 must be filed with the final return or separately if the return was already filed before death. Here is the part most people miss. If you were the surviving spouse and you filed a joint return, you do not need Form 131-0 only if you are also the executor or personal representative named in the will. If someone else is the executor, a child, an attorney, a trust, then even as the surviving spouse, you may need this form to claim the refund. The IRS does not explain this clearly in the form instructions. They bury it in Publication 559 on page 12, paragraph 3. Gloria Stanton, 76, from Prescott, Arizona, filed her husband's final return correctly but never submitted Form 131-0 because she assumed, reasonably, that as his wife, the refund would come to her automatically. It did not. The $2,100 refund sat in a holding account for 14 months until her CPA figured out the missing form. 14 months of her money sitting in a government account earning nothing while she paid interest on a home equity line she wouldn't have needed if that $2,100 had arrived on time. I'd be curious to know, has anyone watching this ever had an IRS refund delayed after a spouse's death without any explanation? Because in the comments on previous videos about estate filing, hundreds of you described exactly this situation. Most of the time, Form 131-0 is the missing piece. Item 3. File the final joint return, or make the election not to file jointly. This one sounds obvious, but the decision itself is where the money is. You have a choice in the year your spouse dies. You can file a joint return for that tax year, covering income earned from January 1st through the date of death, or you can file separately as married filing separately. In roughly 80% of cases, filing jointly saves money, but not always. If your deceased spouse had unreported income, gambling winnings, business losses being audited, or owed back taxes under their individual SSN, filing jointly makes you liable for all of it under IRC Section 6013. D3. This is called joint and several liability, and it means the IRS can come after your assets, your bank account, your Social Security check, your home, for your dead spouse's tax debt. Wait, it gets worse. If your spouse had an outstanding installment agreement with the IRS that you didn't know about, filing jointly can collapse that agreement and accelerate the full balance due immediately. Richard Okonkwo, 67, from Columbia, Maryland, filed jointly with his deceased wife in 2023, not knowing she had a $22,000 installment agreement with the IRS from an old business. The joint filing triggered a full assessment. He received a notice for $22,000 plus $3,100 in accumulated interest, all of it now his responsibility. The filing deadline for this return is April 15th of the year following death. If your spouse died in 2025, you have until April 15th, 2026. But you can also file earlier, and in some situations, filing early protects you from penalties on items 4 through 7. Now, number 4. This is the one Margaret missed. This is the one that carries penalties starting at $5,000 and scaling up to the full value of the inherited IRA. And this is the one that has a deadline most accountants miscalculate, because the IRS changed the rules in 2020 and then changed them again in 2024 with Treasury Decision 9981. If your spouse was over 73 and had a traditional IRA, they were required to take a minimum distribution every year, their RMD. If they died before taking that year's RMD, the obligation does not die with them. It transfers to you. You must take their remaining RMD by December 31st of the year they died, not by the filing deadline, not by the following April, by December 31st. If your spouse died in October, you have roughly 60 days. If they died in November, you might have 30. And the penalty for missing it is brutal. 25% of the amount that should have been withdrawn. Under the old rules before the Secure 2.0 Act, it was 50%. But even at 25%, the numbers are staggering. Dennis Caldwell's 2 IRAs had a combined RMD of $12,400 for 2024. He died in March, having taken none of it. Margaret had until December 31st, 2024, to withdraw that $12,400 from his IRAs that were frozen during probate, held at a custodian that required a death certificate, a letter of testamentary, and a new account application before they'd release a single dollar. By the time Margaret's attorney got the paperwork processed, it was January 8th, 2025, 9 days late. The penalty, 25% of $12,400, that is $3,100. But the IRS also flagged her for the separate late filing penalty on Form 5329, which added another $11,700 in proposed assessments that her CPA is still fighting to abate. Some tax professionals argue the IRS should grant automatic relief under the reasonable cause exception in these cases. Others say the IRS rarely grants it without a formal appeal. The outcome depends heavily on which office processes your case and whether you file Form 5329 with a letter of explanation attached. If any of what I just described made you pause, if you realize this could have happened to you or someone you love, hitting the like button is a 2-second action that tells the algorithm to push this video to other widows and widowers who are right now sitting in that 60-day window without knowing it. That small action could save someone thousands. Here is what you should do if you're in this situation right now. Call the IRA custodian, Fidelity, Schwab, Vanguard, whoever holds the account, and tell them you need an expedited inherited IRA distribution to meet the deceased owner's RMD deadline. Use those exact words. Expedited inherited IRA distribution to meet the deceased owner's RMD obligation. That phrase triggers a specific processing pathway at most custodians. But there is something else the IRS expects that connects directly to this thumb, and it involves a form most CPAs don't file until it's too late. When your spouse's IRA custodian distributes that RMD, whether to you, to the estate, or to a named beneficiary, they are required to issue a Form 1099-R. But here is the problem that catches widows constantly. The 1099-R might be issued under the deceased's Social Security number, under your Social Security number, or under the estate's EIN, depending on how the custodian processed the transfer. If it's issued under the wrong number, the IRS computer system cannot match it to the correct return. The result is a CP 2000 notice, an automated underreporter notice, that proposes additional tax you don't actually owe. Imagine you're grieving. You've already navigated 4 complex filing requirements, and then 6 months later you receive a letter saying you owe $4,200 in additional tax on income you already reported. That is what happens when the 1099-R coding is wrong. Your action step. In January of the year following your spouse's death, contact every financial institution that held your spouse's retirement accounts. Ask them to confirm which Social Security number or EIN will appear on the 1099-R. Ask them for the distribution code they will use in Box 7. Code 4 means death distribution. Code 7 means normal distribution. If they use Code 7 instead of Code 4, it can trigger additional scrutiny. You want Code 4. Write it down. Verify it. This one sounds unrelated to your spouse's death, but it is directly connected. When your spouse dies, your Social Security benefit changes. You might begin receiving a survivor benefit. You might switch from your own retirement benefit to a higher survivor benefit. Whenever your benefit amount changes, your tax withholding should be recalculated. The IRS doesn't do this for you. Social Security doesn't do this for you. If your monthly benefit increases by $800 when you switch to the survivor benefit and your withholding stays the same, you could end up owing $2,000 to $4,000 at tax time, plus an underpayment penalty under IRC Section 6654. Patricia Nguyen, 70, from San Jose, California, switched to her deceased husband's higher Social Security benefit in May 2024. Her monthly check went from $1,840 to $2,610. Nobody told her to update her withholding. At tax time, she owed $3,200, money she didn't have liquid because she'd already spent the larger checks on medical bills and funeral costs. Form W4. V lets you elect 7%, 10%, 12%, or 22% federal tax withholding from your Social Security check. After a spouse's death increases your benefit, most tax professionals recommend moving to at least 12%. You file this form directly with the Social Security Administration, not with the IRS. Call SSA at 1-800-772-1213 or submit it at your local field office. If you've made it this far into this video, you're clearly someone who refuses to be caught off guard by the system. Subscribing means you will see the follow-up video I am releasing about the 5 IRS letters that arrive in the 12 months after a spouse's death, what each one means, which ones you can ignore, and which one requires a response within 30 days, or you lose your appeal rights permanently. That video connects directly to what we're covering right now. This is the form that most people skip this part for. It sounds bureaucratic. It sounds optional. It sounds like something only estates with attorneys need to worry about. Do not skip this. This 90-second explanation could be the difference between receiving IRS correspondence about your spouse's tax matters and having it disappear into a dead letter file where nobody responds and penalties accumulate silently. Form 56 tells the IRS that you are the fiduciary, the responsible person, for your deceased spouse's tax affairs. Without it, the IRS sends all notices to the deceased's last address of record. If you've moved since the death, or if your spouse's address of record was different from yours for any reason, a previous marriage, a business address, a P.O. box that expired, those notices go nowhere. Penalties accrue. Interest compounds. And you don't find out until the IRS files a federal tax lien or sends a levy notice to your bank. Carl Jameson, 71, from Fort Wayne, Indiana, never filed Form 56 after his wife died in early 2023. His wife had a small consulting business with a final quarterly estimated tax payment due. The IRS sent 3 notices to her old business P.O. box, a box Carl had closed 2 months after her death. By the time a final notice reached Carl through certified mail to his home address, the original $1,100 payment had grown to $1,100 plus $340 in penalties plus $89 in interest. Form 56 would have redirected every piece of IRS correspondence to Carl's home address from day one. You file Form 56 with the IRS Service Center where your spouse's last return was filed. You can find the correct address in the instructions for Form 56 or in IRS Publication 559, page 6. File it within 60 days of death, sooner if possible. Now, here is what nobody connects, and this is why I structured these 7 items in this specific order. Items 1, 3, and 7 are linked in a way that creates either protection or catastrophe depending on the sequence. If you file Form 56 first, before the final joint return, the IRS system recognizes you as the fiduciary before processing the return. That means any discrepancy on the return generates a notice that comes directly to you at your current address, with response deadlines measured from the date you receive it. But if you file the final joint return first without Form 56 on file, any discrepancy notice goes to the deceased's address of record. You might never see it. You might find out about it only when a levy hits your joint bank account, a bank account that is already half frozen because of Item 1. The sequence matters. The order is Form 56 first, IRS death notification second, then the final return, then Form 131, O if applicable, then the inherited IRARMD, then the 1099-R verification, then the W-4V update. 7 items. Specific order. Specific deadlines. The system was not built to guide you through this during the worst week of your life. It was built to process paper. Your grief is not a variable in their algorithm. Here is your Monday through Friday action plan. Monday, file Form 56 and send the IRS death notification letter to the Cincinnati office. Tuesday, Call every IRA custodian and request expedited inherited distribution paperwork. Wednesday, call SSA at 1-800-772-1213 to report the death, ask about survivor benefits, and request Form W-4V. Thursday, gather all income documents needed for the final return and schedule a meeting with a CPA who specializes in decedent returns, not a general practitioner, a specialist. Friday, contact each financial institution holding joint accounts and request written confirmation of how any 2025 distributions will be coded on their 1099-R. 5 days, 7 items initiated, all deadlines protected. You now possess a filing sequence that most estate attorneys charge $3,000 to explain, and half of them get the order wrong because they don't specialize in the IRS side. They specialize in probate. These are different systems with different deadlines and different penalties. Knowing the difference puts you ahead of 95% of surviving spouses who walk into this blind. Margaret Caldwell, the woman from Overland Park whose story opened this video, eventually got her $14,800 penalty reduced. Not eliminated. Reduced. Her CPA filed Form 843, claim for refund and request for abatement, citing reasonable cause. The IRS granted partial relief and reduced the penalty to $4,200. That process took 9 months. 9 months of letters, 9 months of holds on her account, 9 months of a 73-year-old woman wondering if the government was going to take her house because she didn't know about a form that should have been handed to her at the funeral home. She told me, through a source who works with senior tax advocacy groups, that the worst part wasn't the money. The worst part was feeling stupid, feeling like she should have known. She shouldn't have had to know. Nobody should have to memorize IRS revenue procedure numbers while picking out a casket. But the system doesn't care about should. It cares about compliance dates. You spent 40 years building a life with someone. The IRS gives you 60 days to dismantle the financial architecture of that life into the correct forms, filed in the correct order, at the correct addresses, with the correct codes in the correct boxes, or they penalize you for your confusion. In the next video, I am covering the 5 IRS letters that arrive in the 12 months following a spouse's death. Letter 12C, Notice CP2000, Letter 4883C, Notice CP11, and the one nobody talks about, Letter 3064C. Some of these require a response within 30 days, or you permanently lose your right to appeal. That video drops within the next week. The tax code does not grieve with you, but it will penalize you for grieving instead of filing.